What's the one thing that puts a smile on every income investor's face? Cash flow. Steady, reliable, and ideally landing in your account each month like clockwork. The dream is to find a high-yield investment that doesn't just promise returns, but actually delivers them with consistent monthly payouts. In the United States, these kinds of investments have been around for quite some time. Now, they're slowly making their way to Europe. And today, we're taking a closer look at one of the most talked about candidates, the J.P. Morgan Global Equity Premium Income Active UCITS ETF, also known as JEPG. This ETF claims to offer an annual distribution yield of around 7%, while paying out cash flow every single month. Sounds appealing, right? Maybe even a little too appealing. Whenever I hear numbers like that, I immediately start wondering where the catch might be. But that doesn't necessarily mean it's a bad ETF. So in this video, we'll break down the key advantages and disadvantages of this investment. And at the end, I'll share my personal take on JEPG, whether I'd buy it myself, and why. Quick disclaimer before we dive in. This is not financial advice, just my own opinions and experiences. Let's dive right in. So, let's start with the fund size. This ETF has been around for just about 2 years, and in that short time, it has already gathered more than 1 billion euros in assets, and the trend is still going up. Just this year alone, the volume has grown by more than 200%. Clearly, this ETF is extremely popular among European investors, and the reasons are obvious. First, the payout schedule. It delivers monthly cash flow. That's something we, as European investors, have always wanted, but until now, it was hard to find. On top of the monthly payouts, there's also a juicy distribution yield. Last year, it was close to 7%, and this year, it's expected to be even higher, over 8%. So, on average, we're looking at a solid 7% per year. That's impressive. But what does 7% really mean? Imagine you invest 100,000 euros into this ETF. That would give you about 7,000 euros in payouts every year. That's nearly 600 euros per month before taxes. No doubt that's a very nice sum, money you can actually do something with. If you enjoy my content, a like and subscribe means a lot. Thanks. So where does this massive payout yield actually come from? Let's dig a little deeper. First, let's check what's inside this ETF. It's globally diversified. The country allocation looks like this: over 60% in the US, around 10% in Japan, and the rest spread across other developed markets. That's pretty similar to a standard MSCI World ETF. Looking at the sector allocation, something stands out. Technology and healthcare dominate here, not finance and industry like you'd expect in a typical dividend ETF. And if we look at the top 10 holdings, we see an interesting mix. Most of the companies are well-known dividend payers, but some pay only a very small dividend, and some don't pay any dividend at all. That makes it clear. The ETF's 7% payout yield can't possibly come only from company dividends. Here's the trick. This J.P. Morgan ETF works differently than a normal dividend ETF. The payouts don't just come from dividends, but also from option premiums. The fund uses a strategy called covered calls. In simple terms, the ETF owns the stocks and at the same time sells the right to other investors to buy those stocks at a fixed price. For selling this right, the ETF immediately collects a fee. That fee is the option premium. And these premiums are the main reason why the ETF can generate such strong monthly cash flow. Which stocks go into the fund and when they're bought or sold, all of that is actively managed by a J.P. Morgan investment team. So, unlike traditional dividend ETFs that simply follow a passive index, this one is actively managed. That's why it's called an active ETF. And for an actively managed investment, the annual cost of just 0.35% is actually very reasonable. These 5 managers run the fund. In an interview, Hamilton Reiner explained that the ETF aims for about 2.5 to 3% payout from dividends, plus another 4.5 to 6.5% from option premiums. Together, that adds up to a total payout yield of 7 to 9% per year, which is pretty much what the ETF has delivered so far. So now we know. The ETF is well diversified, it provides a very solid monthly cash flow, and that explains why it's become so popular. Honestly, what more could you want? Let's take a closer look at the possible downsides and risks. Here you can see the performance of the ETF since its launch. The red area shows the price development, while the blue line represents the total return, which also includes the distributions. And those distributions are huge. That's the good part. But if you only look at the ETF's price, investors have actually lost a bit of money since inception. That means the portfolio is in the red. High payouts combined with a negative account balance, this is something not everyone can handle emotionally. Now, let's compare total returns between the JEPG ETF and the Vanguard FTSE All-World High Dividend Yield ETF. Vanguard's payouts are tiny in comparison, but overall, it's still far ahead. Why is that? Well, this is the biggest drawback of covered call ETFs. When the market rises strongly, JP Morgan's ETF has to sell stocks at a fixed, capped price. That means it misses out on the full upside. Since mid-April, the ETF has been flat, even with payouts included, as this chart shows total return. Meanwhile, the Vanguard ETF has been able to ride the market momentum and climb significantly higher. There is another point every investor should keep in mind. A regular ETF holds shares of companies, and these stay in the fund until certain rules are no longer met. If a company is no longer good enough, it gets removed and replaced by a stronger one. As an investor, you have at least a rough idea of which companies you are invested in. With a covered call ETF, things work differently. The shares inside are mainly used as a vehicle. They are there to generate option premiums. The holdings are constantly bought, sold, and swapped for others, depending on where better premiums can be earned. So here we are dealing with a very different type of investment. The idea of "I am a co-owner of company XYZ" fades more into the background. Some investors may not care about that, while others prefer to know exactly what they are invested in. Of course, it would be interesting to look further back in time to judge historical performance and cash flow. Unfortunately, this ETF has only been around for 2 years. What we can do instead is take a look at the U.S. version of a similar fund. The J.P. Morgan Equity Premium Income ETF, or simply JEPI, is built in almost the same way as JEPG, but instead of a global stock selection, it follows the S&P 500. JEPI has been on the market for 5 years already and has grown to a fund size of $40 billion US. Wait a second, 40 billion in just 5 years? That's incredible. This ETF is insanely popular. Okay, let's see how it has performed compared to the S&P. Here we see the total return comparison. The curve of the covered call ETF doesn't look bad at all, but with the S&P, you would have made about 50% more profit. And that's in just 5 years. Now let's look at the pure price development. Yes, I know, JEPI is not designed to keep up with the S&P, but I still find it useful and interesting to see how the performance has played out. After all, under the hood, it holds the same stocks. The difference is simply that JEPI has almost no real upside potential. Now let's check the distributions. Here we see JEPI's annual payouts. The cash flow is around 8% per year, which is very nice. The downside is that we cannot expect any growth in those payouts. Looking back, there has been practically no growth in recent years. 2020 doesn't really count, as the ETF was launched in May and had only 6 or 7 payouts that year. I have to be honest, the lack of payout growth is a big negative for me. Why is there no growth? Well, it comes down to the option premiums. Sometimes you earn more, sometimes less, depending mostly on market conditions, but on average it balances out. Let's also take a quick look at the monthly cash flow. Here you can see that the payouts are inconsistent. In some months, investors receive only half as much cash as in the previous ones. This issue is manageable, but the missing growth in payouts is much more serious in my view. So, we've now taken a look at JEPI's history. But what does that tell us? Can we apply these insights directly to JEPG? I think we can. After all, it follows a very similar covered call strategy. It's safe to assume that JEPG's price performance will, over the long run, lag far behind a standard MSCI World and even behind the Vanguard Dividend ETF. At the same time, investors can expect hefty payouts. But growth in cash flow or consistent distributions is not something I would count on. One thing is very important to point out here. I'm not saying the JEPG ETF is bad. On the contrary, despite its weak price performance, I find it quite appealing. The cash flow is simply too tempting. The good news is that over the long run, you'll probably still end up in positive territory with this ETF. There are other funds out there that pay high distributions, but even when you include dividends, the overall performance is still negative. You get cash flow, but at the same time your portfolio slowly loses value. With JP Morgan's covered call ETFs, the picture looks much better. Personally, I'm not buying JEPG just yet, though maybe at some point in the future. For me, it would be very interesting to see how the ETF performs in a severe crisis, like the financial crash of 2008 and 2009. If it holds up well, and maybe even comes out stronger than the regular MSCI World, that would definitely push my decision toward buying. I understand that some investors choose this ETF because they need immediate cash flow, and there's nothing wrong with that. Everyone should do what feels right for them. I still have a few years before I want to live off my investments, and since this type of fund offers practically no payout growth, it's not a priority for me to buy now. Whether I invest today or 10 years from now, my personal yield on distributions would remain the same. So, to sum it up, with this ETF, investors do get high and regular payouts, but they have to accept slower price growth. For many, that's a fair trade. Steady monthly cash flow instead of waiting for big gains sometime in the future. Others, however, want to fully ride the market's upward trend and feel held back here. In the end, it really depends on what matters more to you, ongoing income or long-term growth. And that's the key question we should ask ourselves before deciding whether the JEPG ETF belongs in our portfolio. That's it for today. Don't forget to like and subscribe. Thanks for watching, and I'll see you next time.